Portfolio Builder members, welcome to our Tuesday webinar. We have an all-time record of attendees. I'll open up the mics later. So far we have 16 people in the room and they keep coming in. This is a Q&A webinar with a quick demo of our 3 strategies and really is geared for new folks trying to learn how to follow our program. Once we get you set, it's pretty easy. We're moments away from potentially having a record in the S&P 500, a historic moment. We can see the intraday high previously was 293.88, so we are $1 away from that. Quite incredible. And now this BlackRock warning that a stock market melt up was a bigger risk than a stock crash. So we'll talk about how we feel about that statement in a minute. Let's take a look at our various portfolios and we'll go from there. Okay, so this is our basic strategy right here. It trades Monday, Wednesday, Friday, and it primarily owns the SPY ETF, which is a fund of the top 500 companies in America. And the biggest benefit to owning the SPY is a tremendous amount of diversity. And they are constantly reallocating the funds to match the profits of America's top 500 companies. So you don't have to do anything to rotate various securities in your portfolio when you own the SPY. They do it for you. And this has quickly put a lot of hedge funds and mutual funds out of business because they cannot outperform the S&P 500. And now investors are getting smart. They're just buying the SPY. The SPY is the highest traded security in the world, and it has a unique property to it, which is that it has options expirations ending on Monday, Wednesday, and Friday. So for our target audience who would like to see value growth in their portfolio, but they're more concerned about protection, this provides a very easy way to generate income and protect our capital at the same time through a covered call. And so the edge we have with this program is at least $15,000 to purchase 100 shares of the SPY. And I know you're saying, well, that costs $30,000, but most brokers will let you go 1-to-1 margin, so you can take half of the capital to buy 100 shares of the SPY and still do your covered call. So you could actually have twice the return this portfolio's broadcasting if you used 1-to-1 leverage. Now this portfolio is not using any leverage, and we'll get into the details of that in a bit. Extra profits that cannot count up to 100 shares of the SPY we're putting into this TBT ETF, and I believe that the rates will have to rise in the next year or two, and that this is going to send the TBT much higher. So we'll take a look at that in a moment, and we'll also outline how to actually use your spreadsheet, which you get when you become a member. So again, this trades for about 3 minutes, right at noon Eastern, Monday, Wednesday, Friday. Step 1, buy lots of 100 shares of the SPY. Step 2, if you're new, you'll just skip step 2 and go to writing the covered call. But if you followed our previous trade, then you would you'd buy back your covered call and then write a new covered call. It takes about 3 minutes, noon Eastern, Monday, Wednesday, Friday. And again, the Tuesday, Thursday classes are Q&A and also teaching you exactly how to use the platform. Now, I do know not everyone likes to use spreadsheets, so this product is certainly easy enough to do in your head. You know, all you got to keep track of is how many shares of the SPY ETF do I own, and then I write one covered call for that. Now, if you use Robinhood app, this is the fastest growing broker dealer in the world. They are out of San Francisco, valued at $5 billion, and private equity investors are paying for all of your commissions. It is by far not only the best deal in commissions out there, which makes our strategy probably about 10 to 20% more profitable over time, but it also has the best platform in technology to make your life easy. Their phone app is leaps and bounds beyond anything else out there, so you can actually follow this product on the go from your phone very easily. Now, The downside to the SPY is because it's so diversified and it has such little volatility, the yield we can generate on the covered call is a lot less than if we were to buy specific stocks. And so that's where a lot of investors do get into a lot of trouble trying to do something similar to what we're teaching you here today. And for those of you joining in, we're now up to 21 attendees. That's great. This is the most folks we've had as our class keeps growing in size. Now on Tuesdays, we offer a more advanced class. This is called the Diamond membership. Anyone who is on a free trial with the basic, you're not going to be getting these alerts, but on the webinar, I do cover it. And if you do decide to upgrade from a free trial, we do give you 30 days free into the Diamond program. And so for those of you who have a $150,000 portfolio, or rather just half of that, 75, you can use one-to-one margin again and build this portfolio. Now, this portfolio, as we'll soon see, is really just what's underneath the cover of the SPY ETF. So if we look under the cover of the SPY and see what it actually allocates its capital to, we're going to see that this is the breakdown and the relative ratios of how much money is flowing straight from the ETF into the direct security. So what's the advantage of owning the top positions in the SPY? Well, as you can see, this portfolio has twice the return as the SPY nearly, at 15% compared to 8.5%. And they're doing the same thing. While the SPY is taking advantage of these short 48-hour covered calls that are expiring constantly and perhaps has the greatest diversity and protection of capital, this portfolio is only trading once a week. And it has 300 shares of Microsoft, 100 shares of Apple, 100 shares of Facebook, Intel, and Cisco, 200 at Comcast, 900 at Bank of America, and 500 at Wells Fargo. So it's really a beautiful composition of the top corporations in America. And these companies have a few big benefits that's making this portfolio outperform. Number one, because each security individually has a greater amount of volatility, that makes the option premium greater for these individual stocks. And so outside of Microsoft, which almost has done nothing but go straight up for several decades now, you'll see that the yield we can generate from a covered call is far greater on these stocks than just using the SPY ETF on its own. So that's number one. Number two, because the SPY ETF is the highest traded product in the world in terms of securities, these stocks have a consistent stream of buyers flowing into them. So that's two. Three, these companies are amongst the most profitable in the world, which means they have the largest budgets for, you got it, corporate buybacks. And so most of these companies have been leading the way in this rally. Perhaps Bank of America and Wells Fargo are the laggers, but this portfolio is really doing extremely well, and it's somewhere you can park your cash and know that these positions have protection from a number of different reasons. They have monopolies in their market, they have huge amounts of profits, they're buying back their own stocks, and then the top ETFs in the world are flowing their cash straight into these companies. Now, the other advantage of the Diamond program is that we can aim our strike price at different targets per security. And you'll see that Wall Street's pretty accurate at predicting short-term movements in these securities, which is how we determine where exactly to write our covered call. So this only trades on Tuesday, and we're buying covered calls that are 10 days into expiration and then rolling the position the following Tuesday. So we're getting just about half of the life of the time premium, which is where we make the most money in this strategy, and then we roll it over. So we don't want to let these just expire worthless. We'd much rather buy them back and re-rent them out. So it's a lot like being a bank and then loaning stocks. We're in the banking business of loaning stocks to speculators. Our edge is we have the capital saved up to invest in these properties, and we're selling the option to lease them to these call option buyers. So we'll get into a little more of that in a moment. The emerging markets class is Thursday. This is currently a simple buy and hold. And we'll look at the top ETFs outside of the American companies, but you'll see that these are the next top ETFs that we can invest in. These are all just a buy and hold right now and should represent no more than 25% of your total portfolio. And this gives you exposure to the emerging markets. So this is part of the Diamond program, and this is on Thursday's class. Now I want to pull up a slideshow really quick. Here's the NASDAQ. There's that 2000 bubble that crashed. Don't forget Amazon crashed 98% during that time period, even though they were profitable. And now we're getting ready to break into new highs. We had some good news. The housing market's picking up as prices have crashed, so perhaps we're getting towards the bottom of the real estate slowdown. Although big cities around the world are having trouble keeping their prices elevated as people are flocking out of these big cities into more affordable places. And meanwhile, oil continues to march higher. So these are some big things we're tracking to try to determine a few key things that will shape the market's movement from the summer into the next half of the year. So if we look at the SPY ETF, it's the top traded security in the ETF world. By far, it's trading at 290, and its average volume is 61,000 shares per day. As of taking the screenshot this morning, it already had 14,000, and of course, it's gone up another dollar since I took that screenshot. The next highest traded ETF is the QQQ ETF. And it's trading at 188 with 28,000 shares. So you'll see our diamond level product is focusing on what does the SPY and QQQ own. After that, we can see the next top traded ETFs are the EEM, EWZ, and FXI, which lo and behold are the top positions in our emerging market strategy. So if we look at what's under the cover in the SPY, you get a feel for just how diversified your capital is. The biggest position is 3.8% in Microsoft. And so this does hold a portfolio of 500 securities. That gives you a tremendous amount of diversification. Second position is 3.7. Now I did leave out Amazon, Berkshire, and Google because their shares are over $1,000, which would mean the starting cost to follow the Diamond program would jump by 100 grand per each of those companies. So if you do have greater than $200,000, you might consider putting 150 in our Diamond strategy, 25 to 50 in our emerging markets buy and hold strategy, and then anything left over you could flow into our Monday, Wednesday, Friday SPY program. So you get more exposure and better diversification. Now, if we look at the QQQ, very similar setup, but you can see some of those other names in our portfolio: Facebook, Intel, Cisco, Comcast. And if we look at one of the top positions in the SPY is Berkshire Hathaway, Warren Buffett's company. And let's look at what he owns. So he has $208 billion equity portfolio. He's about third in cash right now, trying to pull off probably his biggest buyout of all time before his time comes. But half his portfolio owns Apple, Bank of America, and Wells Fargo. So lo and behold, that's exactly what's in our portfolio. Now let me pull those back up, and we'll just demo how to get these started really fast. So when you first start your free trial, and activate your free trial, you'll get the spreadsheet. If you want to use a spreadsheet, it does help you manage your investments and keep things in order. If you don't like spreadsheets, it's not a big deal. The basic product you can certainly do all in your head. Just a quick overview. These are color coded. And so if we scroll over here, This lets us change where to allocate our capital. The default setting is 90% SPY, 0% growth. This could perhaps become a bigger position if we had a big sell-off, but right now we're trying to play safety and income with targeting the SPY. We have inverse ETF section, which we would only allocate capital to if the market was selling off. And while it seems like that might not happen right now with every day going higher and higher, this photo should perhaps be a little bit of a wake-up call that markets don't just go straight up, they go both directions. So it's important to have protection. If we scroll over here, we have a spot to input the capital you want to trade with. So you would just put a deposit of whatever amount of capital you want to manage with our platform. That's the first step. Second step would be to come over here and it'll give you a trade alert. And our tutorial guides, which are linked to in every email, really go over this in detail. This is where we keep track of buying and selling the stocks we want to hold. And then over here is the covered call. So we open covered calls in this area and then close them down in this area. So that keeps track of everything. In rare moments, we may buy a call option or a put option, but that is a very rare time, especially in our basic program. If we did want to make money from a downside move, we would move allocation to these inverse ETFs. One is TECS, which is inverse tech, and then one is the VXXB VIX ETN. So right now, that's not something that's in our portfolio because we're using the covered call to give us short-term insurance on our portfolio. And that's a really unique thing about doing the covered call, especially at the money or in the money. Normally, to protect assets with insurance, you have to pay money. But with the covered call strategy, we actually can get a speculator to pay us a guaranteed profit if the market goes up and some insurance on the downside at the same time. And so for folks who are more concerned about protecting capital and making a consistent gain, this strategy makes a lot of sense. Now, if you're 20 or 30 and you don't need the money right now, you're just trying to let it grow, this is still a beautiful platform for buy and hold, but it wouldn't take advantage of what we can do with the covered call. Now, in this platform, it's very similar. If you wanted to take out Microsoft, you could just put 0 here. Microsoft has the lowest yield on the covered call of the total portfolio, so you might say, well, I'd rather juice this up a little bit. I'll go to 63 here and put that at 0, and you can see it creates instant trade alerts telling me what to do. Sorry about that. And so that's how this software works. If you have a positive, it counts as a buy, and if you have a negative, it counts as a sell, and it automatically flows up to here so that you can keep track of how many shares you should own of each security. Now, if we look over here, you can see now the spreadsheet is a lot more valuable because we're suddenly having to track 8 securities instead of just 1. So if you were to do the Diamond program, that's when I would highly suggest you do use the platform instead of just trying to do it in your head. Once again, we have these settings up here to control exactly where we allocate our capital. And from time to time, I will update this template and reissue spreadsheets to everyone. But this is a slowly changing thing, the top leaders in the SPY. So it's not something that would be updated very often, perhaps once every 6 to 12 months. These allocations and ratios might slightly alter. Over at the emerging markets, same setup. We have access to precious metals in this area. We have an OTC stock that I really like, Tencent, TCEHY. They own Fortnite, Clash Royale. They actually own a lot of what they call unicorn tech companies. They've been gobbling them up. And then we have these country-based ETFs, which give us exposure primarily to what's under the hood in the emerging markets ETF. So we get China, South Korea, India, Russia, and Brazil. So that's a good outline of how we have these three products set up. Thursday, we give you any changes to the emerging markets class. Tuesday, we give you any changes to the high yield strategy. And this is typically just doing a covered call every Tuesday, buying it back the next Tuesday, and then writing a new one for not that Friday, but the following Friday. In terms of other stuff we're carefully watching, the dollar continues to march higher. If the dollar were to get weak, that would probably signal us to allocate a little more capital to the emerging markets, but that trend just does not want to happen right now. We look at the Kospi as a leading indicator, still bullish. If you listen to all the hedge fund kings who sell bonds, their big prediction is that in the next 5 to 10 years, we're going to start to reverse this shape. So we've had 35 years of decreasing interest rates, and now they're expecting a reversal to show these interest rates going back up. So of course, that'd be very negative for the stock market. If it costs more to borrow money, people aren't going to be so euphoric about borrowing money and plopping it into the S&P 500. The biggest thing that pushes rates higher is the inflation rate, which has been very low. So that gives us the confidence to continue with a relatively bullish strategy right now. And then this is the chart that we got to remember. If we were to invest in the Dow in 1964 or 3, it was gravy going straight up, and then we had about 30 years to get back to even. And that's where we had inflation. We had a lot of programs put into the government that inflated the monetary supply. We got runaway inflation, and it took raising rates extremely high to reverse that course. So of course, there's a lot of other things that happened in that period, like a Cold War with Russia. So there's a lot of parallels that I'm seeing in today with China, perhaps turning into a Cold War over time, as well as we're seeing a lot of Democratic presidential candidates who are trying to really expand all the different policies that would create more and more debt. So that's something we're keeping lookout at. Right now, the inflation's low, the rates are low around the world, and the treasury rates are still very low. So this is all very bullish and helps understand why the stock market is so high right now. Pull back up our spreadsheet, look at a few other slides. So going into earnings, this is a trick the corporations love to do. They downgrade their expectations leading into earnings, and then what do you know, they beat it and everybody gets excited and the stocks go higher. So that was the tone for the last few weeks if you're listening to your favorite TV stations, and they were estimating low earnings, and now they're all beating them, and we've got lots of earnings coming out this week. So who knows, we may even pop higher than we are right now. But it's been kind of a funny rally. The crash in December scared everyone. A lot of hedge funds went out of business. A lot of people wanted to take losses while the market was down to write off against their profits. But in general, the people who've been buying this rally primarily were number one, corporate buybacks, and then number two, the Bank of Japan is one of the biggest buyers of stocks in the world, and one of actually the only major central bank that's allowed to do that. In terms of other data, interest rate expectations have troughed, so at some point I'm expecting the people like Ray Dalio, they're sitting on a profit in their bond portfolio and their stock portfolio, and typically it's just one or the other. So there's going to be an opportunity for some huge profits to be realized for the hedge funds out there, which might put a stall on this rally. And as we look, you'll see that the market's really not prepared for any sort of shock right now. The VIX contracts are extremely short. Everyone's just shorting the VIX lower and lower. And so everything's looking good, except that the market is not prepared for a pullback. So let's look at today's diamond trade alert and just look at some of the volume. So when we prepare the trade alert for the diamonds, the first thing I like to do is look at where Wall Street's betting on the SPY, so the general market. And we can look at two things, open interest and volume. So open interest is the amount of contracts that are currently open that have been bought at any time prior to today and are still open. And that can oftentimes give us an idea where the market may end up at that expiration. And then we can look at the short term. Where's the volume flowing in at this moment in time for that day? So we could see as of this screenshot, the market was betting up. Everything was flowing into the call options, and the open interest is heavily skewed to the call options. The only heavy open interest on the put side is this 290 expiring in 60 days. And when we took this shot, SPY was at 291.74. So it just goes to show how influential this option data can be on at least the short-term impact on the stock. Emerging markets had a very similar setup, almost nothing going into the put options, a little bit flowing into this in the money put option at 45, but a lot more into the call option. So our trade alerts were relatively aggressive. So you can see Microsoft, lots of volume on the call side, nothing on the puts. Still played it safe. We took a 285 credit when it was trading around 125. So we're agreeing to sell our shares for $1 loss, but we're picking up 285 per share on the option. So this is one of those circumstances where a speculator is actually willing to pay us almost like insurance to protect your assets, plus give you a guaranteed profit if the market goes up. So we get the best of both worlds. We have protection to the downside for free, and we can generate a profit if the market goes flat, up, or slightly down. Now, if we look at the chart on Apple, they have earnings coming out at the end of the month. And of course, you've seen this is one of the biggest positions in both it is the biggest position in the QQQ, and it's the second largest position in the SPY, and it's the #1 position in Warren Buffett's portfolio. And you can see that the market did have a little more volume on the put options on this side over here on the right. There's a good amount on the call option side, so it's a little bit of a mixed bag. But because of that, I chose the 202.50 strike for $7.38 a share. So again, we have around $7.38 of protection for free and still make some profit if the Apple shares go up. And so that is a huge advantage when you can make money in multiple directions and not have to pay for any kind of hedge to protect your asset. Now, that's not to say I don't want to buy products that will profit from a downturn. But the thing is, I would rather wait for the downturn to start and pay a premium for those and then use covered calls when we're just kind of worried. Like right now, we know the market's very highly priced, so everybody's worried. Are we going to break into new highs? Are we going to go sideways for a while? Or are we going to get another volatility spike? And so from week to week or day to day, the covered calls are first line of defense. It gives us a risk-free way to have some protection and still generate a great return. And if we do see a sell-off, that's when we would start to look at other options to further profit from downturn. And so the trades today were relatively the same on each of these. Our portfolio has just been rocketing up. Cisco had rocketed up and then pulled back right before covering today. So we actually got to profit on both sides, on Cisco, on the equity, and on the covered call. And really just the banks are kind of the laggers right now. Bank of America had a big shoot up, but Wells Fargo is still slacking. Meanwhile, perhaps the catalyst that could take us to new highs would be a meaningful deal with China, which they're now saying is aiming for late May. So we'll see how that rolls out. And that's a good overview of our total product. I'm gonna go ahead and open it up for Q&A now. And I will say, if you do want to save on a membership, if you're on a free trial, or if you do want to upgrade to Diamond, call Dean or Mike. There's their numbers. Let me go ahead and see who we got on here today, and we'll try to get a little dialogue going on. Okay, so we have quite a few people on here. I'm not going to unmute everyone because it'd probably create too much noise, but if anybody has any questions and would like to start posting them in the chat box, let's go from there. And if your question does seem a little complex, I'll unmute your particular microphone. Now, don't feel like any question is a bad question. If you're wondering it, most likely someone else is. So there's no stupid questions. And okay, we have one question. Let me expand this. How do I know if I'm enrolled in the basic? Well, if you are on the webinar, you are enrolled on the basic, most likely free trial. So I'll make sure to have our team reach out to you after the webinar to explain what exactly you have right now and what to expect. So no worries on that. Mike, oh, Jerry, is that you there, Jerry? Okay, Henry's asking why the spreadsheet double counts your short option credit and the profit. Well, it multiplies it by the number of contracts. So you can see the credit is calculated by multiplying the option price times the number of contracts times 100 is the credit. And then that simply flows to your profit. Now, I do want to point out that for some reason you're labeled as Mike. Yeah, I'll pull up your, post your exact email again, Jerry, and I'll pull that up in a second. Now, I do want to point out that the ROI is more accurate after we cover our position versus after we write the covered call. So in this portfolio, for example, I took the screenshot of our profit loss before writing the covered call and after covering last week's. So that's when you're going to see your true profit. That's where you're going to see your true profit. Okay, Jay, I'm not sure why you're not getting the webinar. I'll make sure you get it. Let me tell Brian right now. So does that make sense for you, Henry? Okay. All right, great. Well, thanks for taking care of Jerry, Mike. I'll talk to Ryan and see why he's not getting his links. Let's talk a little. Okay, so yeah, keep pouring some questions out here, guys. Let's talk about some of the risks of all these strategies and kind of what our mindset is and how we would react to it. So clearly, our biggest fear is our underlying asset losing value. Okay, I got another. What is the average portfolio value? So, so yeah, these are all model portfolios just to sort of illustrate the different strategies. And I'll pull those up one more time. The basic program can be followed with as little as $15,000 because you can use one-to-one leverage and own 100 shares of the SPY. So that's the minimum for that. Obviously, if you're trying to get towards somewhere in the range of $3,000 to $5,000 a month of income, you're going to need more than just 100 shares. So that's why you definitely want to continue to buy lots of 100 shares of SPY as often as you can. Now, when we don't have 100 shares or enough capital to buy 100 shares, I'm flowing extra capital into the TBT ETF, which will go up as interest rates rise. So right now, the entire world has very low rates. And I believe as the trade war conflict resolves itself, they're all going to start racing to raise rates and try to punish each other's currencies. So that is the trend we're looking at with the combo of the SPY and the TBT. The high yield program, you're going to need closer to 150,000 if you use no margin, or 75,000 if you do use margin. And this has actually averaged $5,000 a month since conception in terms of income, and just doing the covered calls on Tuesday. So the advantage is higher covered call profits because these individual securities are more volatile, and that demands a higher option premium. But the downside is we're only touching this portfolio once a week on Tuesdays. So we're not going to be taking advantage of the options market as much as we do in the SPY strategy. But that's a big benefit, more profit and less work. The emerging markets portfolio, you could turn off all of these. So if you wanted to follow this, you could just be buying shares of EEM and adding up to it over time. For K-Fuller, it's TBT, not TVT. So that's the amount of capital you need to follow each of these three strategies. And again, all of these programs rely on taking advantage of essentially being the bank. We have enough capital to buy the assets. No, okay, Scott says, is this 5,000 a month using margin? No margin at all in this program, or at least in these portfolios. Henry, I'll take a closer look at your question after the webinar, but I don't think it's doing that. Okay, so keep loading your questions up. I'm gonna talk about what we're all scared of, obviously, would be stock market crash. So how do we deal with volatility? Will the stock market go up forever? Are we gonna break into new highs? You know, that's the question that's on everybody's mind. In the long run, you know, we look at the world and we know technology and innovation is not stopping. In fact, if anything, it's accelerating. So this is very hard for bearish investors to really fully grasp, is just how fast humans are creating new technologies and automation. And so while the living standards of your average Joe may not be rapidly rising, the profits of these corporations is, and that's because they've been able to automate the production of their products. And so their profit margins have been going up, the prices have been staying stable, and so it leads to a very good environment for stocks. In fact, the stocks are making so much money, they don't know what to do with it, so they're buying their own stock back. And think about it. Would you rather hold billions of dollars of cash, knowing full well that the government's creating deficits and inflating the monetary supply? Or would you rather own, just take your profits and pour it back into your own company, knowing full well it'll probably be worth more in the future? And so that's what the corporations are doing, and that's why I believe in the long run the S&P 500 will be valued much higher today, or rather in 10 years, than it is today. But what about in the short term? How do we deal with this volatility? And I like to use the rental property analogy. Imagine you bought an apartment in a big skyscraper in New York City, and you know that the real estate market's a little tough right there. People are starting to find the rents too expensive. There's a risk that that apartment may have a loss of value in the short term. But if you're renting it out for income, maybe that's not such a big deal, because in time, we don't know exactly when, but in time, New York City's properties are going to go up in value. And so that's the idea here, is that by writing the covered call, we're getting the free protection against our capital, we're generating income, and we're owning the best asset we can get our hands on. But that doesn't mean we don't want to take advantage of volatility in the market. So there's a few things that will happen if stocks start to go down. Okay, the first thing would be a pop in the volatility index, the VIX. And so actually the amount of capital that we collect on the credit from the covered call is directly in a ratio to the VIX. So the lower the VIX goes, the cheaper options get. So that's actually not good for our strategy. We'll actually make a better yield if the markets are choppy and volatile, because it makes option premiums go up. So that's number one. Number two, if we do see stocks starting to pull back, that's when we would allocate capital into these two tickers, VXXB, which is a VIX ETN. Instead of having to buy the call options, which can be a lot harder to manage, we can buy shares of VXXB, and we can also buy shares of TECS. So let me pull up those two charts. So this is an ETF we can purchase. And again, I would want to buy it on a green tick on its way up and not try to predict a bottom. And that's because we're trying to protect our capital and play it safe and go with the trend of the market. We're not a $4 trillion asset manager like BlackRock. We don't have to predict moves before they happen. We can simply go with the flow. All of our audience has typically less than $5 million trading. So it's pretty easy for you to buy or sell your shares, and it's pretty easy for you to get your covered calls written within minutes. Now, if you're a $100 billion hedge fund, you may be the sort of folks who cause these crashes, and you certainly can't get out completely at top prices. So we have a big advantage, and we want to take advantage of that by just going with the momentum of the market. So this is one way we can profit from downturn on top of our covered call. And the second will be this technology bear, 3 times leveraged ETF. And so, it just keeps going lower and lower. And if we break into new highs, this thing's going to go much lower. So that's why we're not building a hedge ahead of the game. Now, I do want to show this just to illustrate how powerful the covered call is at protecting our capital and generating a profit. Now, we do need to remember that right now we're at, let me turn off these other. Volatility is at a low for the year. And so the lower it goes, sure, it makes our life just kind of smooth sailing. We've been racking up profits. No losing trades on the SPY this year. Of course, it's gone straight up. Can't lose money with a covered call on this if your underlying asset's going up. But let's just look at, let's say we thought that the S&P 500 might have a pullback between now and April 26. So that is this Friday. So I'm going to populate that trade ticket. Let's look at what it means to write an in-the-money covered call. So right now, the S&P 500 is trading at 292.81. And in this covered call, I'm agreeing to sell my shares for $291. And on the offset, you might ask yourself, well, why would you do that? That's a guaranteed $1.80 loss. Why would you agree to sell your shares for a $1.80 loss? Well, that's because a speculator is willing to pay $2.34 for the right to borrow my shares between now and Friday. So if he's right, the stocks go up higher, we still make that spread about 50 bucks on the contract. But if we're right and the market's going to flatten out here, we're going to get a good portion of that covered call and get to keep our underlying asset. And so this is how you have a risk-free way to buy insurance for your assets and generate a return at the same time. Now, come Friday, if this trades down towards the 291 price, the value of this covered call will dramatically drop and we can buy it back for probably 10, 20 cents. And that's how we generate a profit if the market's going down. So as the market's going down, you'll see that the entire stock market's very momentous. And once the momentum stops from the upside, I do expect we're going to see a violent push to the downside. And you're going to see all this call option data magically dries up and everybody's pounding into the put options. And so as the volatility increases, we can go farther and farther into the money and have these guaranteed setups where if the market goes higher, great, we get our baked into the cake profit. But if it's traveling anywhere between $3 to $5 lower in a very short time period, we're still making the same boring profit. So that's the first line of defense. If the market's going higher, most likely we'll be writing our covered call right at the money, maybe 1 or 2 strikes higher. And of course, I'd rather do that after a big sell-off, not after a huge rally. At this point in time, we've been a little defensive for almost 4 weeks. We've been very skeptical that people aren't taking profits yet, and the profits still keep coming in. If I had been writing the covered calls a little higher, our returns would be substantially larger right now, but we wouldn't have protected our capital as well as we have. So as the market starts to turn around, you'll see we can write these strikes way lower and still have these guaranteed profits. So right now, we can break even all the way down to this 287.50 strike. So we can have about $5 of protection between now and Friday for free just by writing that covered call. When the time comes, we will probably put maybe a 10 to 20% position into this and perhaps reduce the SPY position a little bit. But that's the general plan. This allows us to have confidence to make money in the market in all conditions. And it's a lot like being the bank. You're the bank and you're picking up the interest on people who are borrowing your shares for short little windows of time. What other questions we got out there, guys? All right, well, that's another great webinar. I really appreciate everyone's time. Don't forget, if you do want to upgrade your free trial, call Dean or Mike, 505-322-7515. And for Mike, 505-322-9884. And Jerry, yeah, I will take a look at your spreadsheet and get back to you on that. Thank you, everyone, for your time. We have another webinar this Thursday, same time. Basic Trade Alert coming out tomorrow at noon Eastern. And we're just going to keep doing this same boring strategy, protect our capital, let the profits slowly grow. And if you haven't tried out Robinhood app in our email, at least download it, try it out. You got to remember, they are the fastest growing brokerage firm in the world. They have private equity that's paying for every single part of the trading strategy, from trading commissions on stocks, ETFs, options, and options assignment. They will give you one-to-one leverage, so you can double the returns that you're seeing advertised here. And because it's a covered call strategy, this is a lot safer than probably anything else you're doing. We're buying the highest traded securities in the world that have the largest positions, and then using the covered call to protect our capital. So you can't beat that. Thanks again for your time, and looking forward to new content coming out tomorrow.